What's up traders, Tom here with another video. Today we'll be discussing the stock market outlook for 2020, our technical analysis of the S&P 500 and Nasdaq, and the strange case of the VIX or Volatility Index being unable to properly fall below 30. Stay tuned. Well, they say you learn something new every day, and that's certainly true for me when I'm looking at Wall Street's 2020 outlook. There's some very interesting things to unpack here, so let's take a look. The first one is we have S&P 500 targets all over the place, from as low as 2,500 from people at Barclays to as high as 3,435 over here from CFRA. So there is a big disparity between the expectations of what Wall Street expects in terms of this year. What I want to alert everyone to though is look at these implied PE ratios. Very high, 24, 21, 27. The EPS estimates, very low generally. And when we compare these to 2019, look at 2019's EPS estimates and implied PE. So much, much higher. And notice how close all of them were with their expectations. Of course, there were some standouts. UBS down here was quite bearish on the whole thing. And there was a lot of bearish sentiment still out there. But generally speaking, if you took the average, which is what I like to do, never take any one of these ones, take the average, you usually get to a fairly decent yardstick in terms of making some form of economist's idea of what's going to happen. And I like to do that. I like to take about 10 to 20 of them and take that average. But it gets even better than that because Goldman, our favorite one on this channel with their best picks ever, have now changed their view again. And for anyone that would know, when we really started taking this channel seriously probably about a month ago, we were talking about Goldman and they've changed it 3 times, I believe, since we started in terms of the expectation. And we're not talking small changes, we're talking very big ones. So we have now gone from 3,000 back to 2,400, and now we're above 3,000. So we have now gone to a high end 3,200 from the 2,400 with a 2,750 low. And to me, this looks very much like someone has looked at the charts and gone with the technical analysis approach. And when we look at the S&P 500, I'll reference this to show you what I mean. But very interesting. Overall, it looks like the outlook is pretty much around where the market is right now. So as we said in those videos, and I'll tag one up here, risk reward does not seem like it is worthwhile in the market as a whole in terms of getting a whole bunch of new positions if you're wanting to add big quantities. The stock market, of course, is not reflecting reality according to Citigroup, so they're obviously quite bearish. I wanted to quickly let everyone know that if you're trading oil and you do not know about OPEC or OPEC Plus in terms of their meetings, there is now a meeting on June the 4th rather than June the 9th and 10th. And this is important. If you do not know about these moves and you trade oil, you can get destroyed. So make sure you're always aware of OPEC. It's so important to know their meetings. We have something that's real news, I think, today, and that is that the US stock futures are turning lower. Now, of course, the stock market is now open, but it's really about China is pausing the soybean purchases and a few other purchases. I believe this purchase was part of the original deal. Let's call it phase 1 or whatever the deal was. And it is kind of worrying. I mean, remember the market was freaking out about this trade deal issue and growth slowdown before this whole entire crisis. And now it's all just about every single bad bit of news is being just completely shaken off by, oh, the Fed will save it, the Fed will save it. And I think that's a dangerous kind of concept. So here we have what happened in terms of the futures. We had the riots, obviously unfortunate riots. The market didn't really care about that. Look, that's to be expected. It's obviously a different kind of thing, at least initially. And then we have China halt some imports. The market went down. And then, of course, the market went straight back up pre-market. Didn't really care about it. So this is the state of what we're seeing. Any piece of bad news is not being considered at all. And I think a lot of it is to do with the trap in general when it comes to the market. Are there lots of bullish cases? Yeah, there always is when it comes to this. There's bull side and a bear side, and you can make great arguments on either side. But I always like to look at whatever the retail investor's doing, because unfortunately, retail investors are the easiest people to take money off from Wall Street. So here is Robinhood in terms of user positions in S&P 500 stocks. And take a look at this. Massive amounts of purchases on the way down and a huge amount of purchases all the way up. And they're still purchasing. Let's keep going. They're just buying. It's a vertical buy fest. So while a lot of people are bearish in sentiment, there is a huge amount of retail buying going on. And that always makes me think, the more retail buying and the more FOMO that happens and the higher it goes, the faster it goes, the harder it will generally have a correction. So do remember that when it comes to trading. What about the Fed? What about the Treasury? What are they doing? Well, they've been tapering off, of course, their current QE amounts from where they were in the March area. And they're doing this because the market's hit a pretty comfortable area. If I was the Fed and I was sitting right here at this point, I'd be like, yeah, we don't need to do anything else. We'll just kind of leave it here and see what happens in the future. So they've been slowly declining their purchases. And it's very important to know this stat. So make sure you check out the Fed every week and have an idea of how much they're purchasing. It is very, very important to the overall, whether you think there's a lot more upside or not. Because the more they taper it off and the more they lower it, the more the market will just stagnate at that level and potentially bearish sentiment might come back in. Now, could they spike it again? Yeah, they could. But this is where we're at right now. So that brings me to one of my big points before the technical analysis, CBOE Volatility Index, or the VIX. So the VIX is generally talked about as the fear index. And the reason why is it is a real-time market index representing the market's expectations for volatility over the coming 30 days. Investors use the VIX to measure the level of risk, fear, or stress in the markets when making investment decisions. So remember that word fear. Well, here is the VIX over a long term. And of course, I've gone back to 2008 because it is the closest big crash that we had. So we're sitting around 30 right now. And if we draw a quick line across, you will see how high 30 really is in terms of expectation for volatility. So if bearish sentiment comes back into the market for any reason, it is going to be incredibly aggressive. Just like this bull run's been aggressive and the bear run's been aggressive, every move is going to be very, very aggressive. And while we're sitting in this range with 1% or 2% each way, that's nothing compared to those days where we were seeing 7.5% per day and things like that. So this is the calm before the storm in terms of both ways, but most likely if you're going to have a storm, the bear side will be the more aggressive one. So we're above 30, and this is what worries me. Why are we still above 30 when we have made a full V shape on the Nasdaq? So I've got up here QQQ, obviously very, very similar. And in terms of the V shape, we have a full V shape. So the market has absolutely pretty much made a new high. It's very, very close, looking pretty strong, potentially even goes on. But the VIX is still very high. Now remember, this was where the VIX was at the crash that came through into the beginning of 2019 when we had that stuff about China and trade tensions and everything else going on. So this really smashed around the Nasdaq, and that's because Nasdaq is high PE stocks. They are stocks that are valued on growth and needing growth. Now, if you do see something happen with China and America, it is going to affect the Nasdaq. And I think a lot of those Robinhood investors are going to get really, really hurt in terms of what their expectation is. For any seasoned veteran in the market, yeah, if you hold quality and you hold it long term, of course you'll do fine. But these people don't know that. They've never expected or experienced some form of loss. I know plenty of people that are very young that have just bought their first ever stocks. And it reminds me kind of of Bitcoin a few years ago. They put $10,000 or $20,000 or $30,000 into Bitcoin. It started crashing and they started absolutely fleeing and pulling it all out, and it created like a little bit of panic, and some of them just lost everything and moved into other stuff. So they make every mistake in the book is what I'm trying to say. And there are a lot of retail investors purchasing the Nasdaq right now. So look, are tech stocks in America great? Yeah, some amazing companies, no doubt, amazing companies. Are they going to do well long term? I'm sure many of them are going to do amazingly. I like quite a few of them. But that doesn't change. Volatility has always been a big part of these stocks, and they are not really very fairly priced when you're looking at them as a whole. So on to the technical analysis. Well, I wanted to quickly bring up the ASX 200, which is our index here in Australia. And I did that just because we didn't quite hit 6,000, but we did get a very big rejection candle, followed by actually a big bearish candle. And this is a pretty interesting kind of setup that we're seeing here. We haven't made a new low yet, but I think this is showing the kind of bearishness that can come into a market very quickly when you don't have as much support as you do in the S&P 500. We are at a key level in terms of Fibonacci. We're at a pretty key level as well. We're at about that 50%. And I've said on this channel several times, in terms of shorting the market, you're actually better off to look at the other markets and look for the triggers from the S&P 500. So if the S&P 500 goes under, let's say 2,800, if it gets back down there and goes under that level, that is a key support. But you will see even better opportunities, most likely on other indices. So I have been saying that a little bit, and I think it is very much an important fact when it comes to your investment decisions. Here we are in terms of the S&P 500, what a lot of people like to see. And we are above 2950, no doubt. We've got above the 3000 psychological. We've broken through the 200 moving average. It was just sitting here around the 3000. And we are sitting in a zone where it is climbing higher day on day, possibly to the 3150 kind of zone. Remember, 3200 was the Goldman pick. Notice how we have previous supports at 3200. So I'm sure that is why they've picked that zone. Now, why do we think they've picked 2750? Because 2750 is the last point of heavy support, just under 2800 supports over here. So that's why I said Goldman have definitely just picked those levels based on just looking at the charts and saying, well, where are these key levels now that we're here where we are? And that's pretty much where most likely it will channel to. I think things like the resistance here though, and the support here at around that 3150, that's the next target for the bulls. My big problem is the volatility index and how high it is. If we take a look at the volatility index right now, we can see that the volatility index is still sitting around that kind of just under 30, around that 29.7, 30 area. It is forming a base. And whenever we see a base being formed on any chart, generally that means a form of support. And I think it coincides a little bit with the Fed balance sheet stuff. They've been tapering it back a little bit, bringing it back into line. And the volatility index is there saying, well, are you going to support it if it happens? And it's not sure. So at this stage, we still have this increased volatility. And of course, all of the other concerns while we see the markets reopen. So for now, I think there is two key risks that we really need to be talking about. One is the US-China tensions. I think that is a big deal in terms of the markets. I don't even know if the Fed can really support those kind of things or whether they're even going to. And of course, then the second wave. What kind of damage would a second wave of this current crisis cause the economy? Would the Fed be able to combat it? Would it combat it? They are the main unknowns. There are so many things with the corporate market, but as we've seen, the big companies are doing okay because they have decent cash flow and they've been heavily supported. What hasn't been supported is the small caps. So things like the Russell 2000 are struggling. And PE is incredibly high. It's pretty much been the highest it's ever been over here in terms of the earnings. And it looks like these companies are not getting the support. So remember, I said before, the S&P 500 might be the trigger, but always look at other indices as the option or availability of a potential better trade to trade the same direction that you're looking at on a certain market. Because trading against the S&P versus trading against something like the Russell will probably degrade, whereas the S&P could be potentially saved by the Fed. And that's something you want to think about when you're placing these trades. If you've enjoyed this video today, make sure to subscribe and hit that bell, and let us know in the comments down below which index is still your favorite, keeping in mind that. Do you like the Dow? Do you like the Nasdaq? Do you like something else in terms of exchange traded fund that tracks certain indices? Let us know down below, because we'd love to see what the community is thinking in terms of their favorite index to either trade or potentially the next one they're looking at as a target investment. So let us know in the comments, and of course remember to give this video a massive thumbs up, and happy trading, and we'll see you in the next video.